Hello again, Abraham.
Hi Robin, how are you?
I'm very well, thank you. And I'm really looking forward to hearing what you have to say about our latest interview. It's with Crawford Spence, Professor of Accounting at King's College London. He's the author of a new paper on active fund management.
So tell me, what have you been finding out?
Well, it's basically about what active fund managers really think of passive investing. But before we go into the meat of it, let's hear what Professor Spence has to say about the academic evidence on active and passive investing. Specifically, which one's better?
So the academic evidence has been pretty clear on which is better, active or passive investing. And this is nothing new. We've known for decades now that really over the longer term, passive investing delivers much better returns to investors. I was actually quite surprised when I first learned this, when I started looking at this field about 5-10 years ago. I was really astonished that the returns were so much better for passive investing because asset management, active asset management is still a big field. There's still a hell of a lot of money that goes into that space. For example, any given year, you might find half of the active fund managers outperform the relevant benchmark, meaning that they beat the market. However, if you fast forward to maybe, a sort of 3, 5 or 10-year time horizons, the number of active fund managers who beat their benchmarks really dwindles quite rapidly, to the point where if you look at a 15-year time horizon, almost nobody beats the market in the active fund management space. You're looking at 10 to 15% of people over that time horizon. And those people cannot really be identified ex ante. You don't know who they're going to be beforehand. And the other complicating factor is you don't know if they've beaten the market because of skill or because of luck. So, you're really talking about a very narrow number of people and very hard to identify, and you don't know why they've beaten the market either. So, the best person I think to encapsulate this or describe this game of active fund management was Charles Ellis back in the 1970s. And he called it a loser's game based on this sort of statistical evidence.
The latest study Professor Spence has contributed to is called Active Fund Management and the Rise of Passive Investing, and you'll find it in the March 2023 edition of Economy and Society. The researchers interviewed 70 people in London, New York and Chicago, mainly asset managers, but also equity analysts and other professionals connected to active fund management.
The interesting thing about this study is that the study morphed from one thing into another almost serendipitously. We actually went to interview them on a relatively narrow range of topics, trying to understand how the relationship between fund managers and investment banks was changing due to some regulatory changes. So it's quite technical, quite niche. But what we kept hearing back from people was that they kept talking to us about passive investing. We never went there to ask them about passive investing, but they kept talking about it. So they obviously had this on their minds. They obviously had a certain degree of anxiety about it. And what they kept telling us about passive investing was that it's growing and it's disrupting their market share. Passive is eating their lunch. More and more funds are going over to passive, away from their space, the active fund management community. So as a result, we decided to start looking into this in more detail. So we started to ask them more questions about passive investing and why it was such a big deal, how it was changing the way in which they operated, whether they thought they had a future in the active fund management space, and what the merits or disadvantages were of, say, a passive investing approach versus an active investing approach, and vice versa.
What started then as one study became a rather different one. So what exactly did active managers say that so surprised the researchers?
The fund manager said a few things that surprised us. Firstly, because we were not asking them about passive investing, the fact that they kept talking about passive investing said to us as researchers, oh, that's something we need to pay more attention to. Because if people start answering questions you've not asked them in research, that's seen as an indication of something that you need to pay attention to. So we found that interesting. But more specifically, once we got into the weeds of what active fund managers thought about passive investing, we realised that there was a lot of psychological complexity there. But the thing that surprised us the most, that there were so many active fund managers that saw the benefits of passive investing, to the point where some of them even said to us, all of my own money is in index funds. Index funds is the main type of passive investing vehicle. Or other people said to us, I would not invest in my own fund. Which really is quite remarkable, given that their livelihoods are based entirely upon active fund management, which takes a very radically different approach to passive investing. With academic research, you always say to them, this is anonymous. They won't be named, their firm won't be named, and still people are going to remain tight-lipped in that environment. But actually, you're always going to find, 20 to 30% of them just want to offload whatever they're experiencing, and they see this as an opportunity, not exactly as therapy, but nobody else, they can't have this conversation with anybody else, really, So in some ways I was surprised that they were so forthright about how much they thought index investing was a better approach. But in another sense, I suppose I wasn't, because you always get people opening up to you in these research situations.
According to Professor Spence, active management is an example of what some academics have called a community of practice. Other industries have these communities too. Interestingly, he says, active management exhibits all the hallmarks of a community under threat.
So in the paper we use the phrase epistemic opportunism, which is kind of a fancy way of saying that the people we interviewed used kind of convoluted arguments to try and justify that their way of approaching the market, of understanding the market and acting upon the market, and ultimately investing in the market was the right way. So they engaged in various forms of, you could call it intellectual gymnastics, to try and justify why active management is still superior to passive investing approaches. Because remember, they kind of conceded the superiority of index investing and other passive investing approaches. But then at the same time, they also became very defensive about why active management was still superior in their eyes. So that this is why the work on communities of practice we found very interesting, because when communities are under threat, they tend to do various things. They tend to sort of hunker down and defend their own identity. And we saw this in the people we interviewed, who kept saying, well, I can compete with supercomputers, or I can do fundamental analysis and speak to someone on a barge in New Iberia, or I can interpret the body language of a chief executive in a way that a passive fund cannot. So that's really kind of reinforcing their own identity. Another thing that communities will do when they're under threat is to delegitimize their opponents, basically throw stones at your competitors. And they did this a lot by accusing passive investing for being responsible for all sorts of wonky price movements in the economy. And they said only they, as active fund management, could engage in what they called price discovery, which is finding the true price or the real value of a particular stock, which is kind of a hyperbolic, bombastic claim that there even is such a thing as a true value of a stock or a true price. But nevertheless, that's an argument they came up with. And there were other things they did as well, which is consistent with what happens to communities when they're sort of faced with an existential threat.
Something else the researchers found was that the people they interviewed tried to frame areas of asset management as inaccessible to anyone other than active fund managers. An example is ESG investing.
And the argument they came up with in this regard was that only active fund managers can really undertake ethical investing, because index investors just put their money into a basket of stocks and leave it there. They don't make screening decisions. They don't say, oh, we're not going to invest you in an oil company because we have to own everything that's in the index. The active fund management community say that, well, we can screen them out of our investment processes if we want to, and put real pressure on companies, which is an argument. I mean, there are lots of counter arguments to that as well. I mean, BlackRock, the biggest asset manager on the planet, and has huge positions in index investing, and they have massive engagement teams as well. So I'm not saying one is better than the other in this respect. I mean, if anything, we probably shouldn't be putting our faith in asset managers, either passive or active, to try and save the planet. But the argument that active fund management is in a better position to do this, I think is very specious, and there's no way that they have the moral high ground on this. If you look at their history of engagement, it's really, really very poor. You know, the other argument they come up with is, oh yeah, passive has been successful because the last 10 years has been a bull market. Wait till a bear market comes and you'll see the advantage of active fund managers who can hedge positions and, you know, short sell and do all these other things that index funds cannot do. But again, the research shows pretty consistently that passive funds do better in bear markets than active funds do. So this other mechanism really is hopeful fantasizing, you know, which is consistent of a community that's basically under threat. It's trying to defend itself.
So this research shows that active fund managers are privately acknowledging that passive investing is superior, but don't expect them to admit it openly.
So I don't see anything changing in terms of active fund management. I don't see active fund management turning around and saying, oh, you know, we've had, you know, 50 golden years of, you know, earning very high fees for very little returns delivered back to our clients. Let's change our ways. I think as long as they're given assets to manage, they're going to try and do that in the only way that they know how. So they're very stuck in their ways in this respect. So I think the real issue is how to redirect flows away from active management towards areas that work much better for your average investor. And, you know, that has happened a lot in the last sort of 10 to 20 years. You know, the market share has shifted way towards passive. That's forced active fund management to push its fees down. It's not changed fundamentally the way in which it does things. It's just led to, you know, fee pressure, which has been beneficial for some people. But they still extol the virtues of what they do. You know, even though many of them concede privately that, you know, they don't have much to offer, and they believe that index investing is superior and they wouldn't invest in their own funds, they nevertheless still continue to set out their stall and to take clients' money. So it still perplexes me to some extent why so many financial advisors and investment consultants recommend active fund management to their clients. You know, we need more research on this to understand why that's the case, to look at the incentives that investment advisors have for funneling money towards active fund management, and also to look at their thought processes as well. So it might not just be about incentives. It might be that they genuinely believe that active fund management is better, or that they believe that they are skillful enough to identify those fund managers that are capable of beating the market, even though the research shows fairly consistently, and has done for decades, that is not the case, and they're very unlikely to be able to select those people ex ante. So I think that's probably someone's next research project, maybe mine, maybe someone else's, but I would really like to know more about that myself as well.
So what did you make of that interview, Abraham? It's very interesting, isn't it, that the industry keeps promoting active fund management, and yet in private, active managers are acknowledging that passive investing may be the better option.
Indeed, I should say I am shocked, you know, that active managers, on the one hand, don't eat their own cooking, but actually I am not surprised. We've known that for some time, that active managers don't tend to invest in their own funds, and indeed that a lot of them actually do prefer index investing to active management strategies. What's interesting about this research is that they are actually acknowledging it, not publicly, but in private, unprompted. And I think investors should take a big lessons from that. If there is this thing, active management, that they are actively recommending, but they are doing something else behind the scenes with their own money, and maybe we should not just take them for their words.
As Professor Spence says, passive or broadly passive investment solutions like the one that you and your colleagues at Timeline provide, for instance, are becoming increasingly popular. But fund managers, equity analysts, investment consultants and so on, they've earned huge fees from active management, and they're not going to give those up lightly, are they?
No, absolutely not. It's very hard to get a man or a woman to understand something upon which their own income or livelihood depends on not understanding. I think, as Professor Spence pointed out in his research, I don't expect that they will pack up and just go home, even though they should.
Final question, Abraham. Professor Spence says his next study will look at why so many financial advisors still recommend actively managed funds. What's your view on that?
Yes, there is a lot of work to be done on actually understanding the reasons. One thing that is becoming clear from the data we have is this generational shift. So what you tend to find is that older advisors are more likely to continue to recommend active investing, although that's changing. But amongst the younger advisors, the new generation of advisors, there is a greater likelihood that they're recommending index investing and following the evidence. Overall, though, an increasing proportion of new money going into investing is going into index investing. So the picture is unclear, and I look forward to seeing Professor Spence's research on that front. So, you've heard our opinions. What did you make of our latest interview? Please send us your views. Until next time, goodbye.